This segment sponsored by Foster Financial. It is time for Wealth Wednesday with Foster Financial, and we have been talking about the process, checking things off the list if you have recently lost your spouse. And today we're going to wrap it up with an important topic that Caleb Doane, the Vice President of Foster Financial, is going to share with us. Hey there, Caleb.
Hey.
Welcome, welcome.
Thanks very much.
Okay, so as we've been having this discussion, I think it's really important because it's like if you lose your spouse, what do you do? And you broke it down each week. And today you're going to focus on the widow's tax trap. That sounds so dangerous.
I know, right? Yeah, it's a serious thing.
What?
Yeah.
What is? Okay, so first, go over the steps just one more time so people can know, and then you can go back and find those conversations because they're so important.
Yeah, we spent a few weeks kind of talking about some of the main categories of things that recent widows would need to do related to their finances. So we talked about gathering the right documents, we talked about contacting the right people, and then about taking the right action. So all those had very important steps for folks to take in there. And one of the things we kind of hinted at in that last session a couple weeks ago was the widow's tax trap and how working with a financial advisor can help avoid some of the issues that can arise, specifically tax issues when somebody loses a spouse. And really what the widow's tax trap is that when you're a joint filer with your spouse, the top of the 12% tax bracket is right around $100,000. If you lose a spouse, you're able to file jointly that year that you lose your spouse, but then the following year, you're now filing as a single filer. As a single filer, the top of the 12% tax bracket is half of that. It's right around $50,000. So the issue that people run into is that when a spouse passes away, sure, they lose a little bit of income. So they'll lose like the lower of the two Social Security benefits between the two spouses. But a lot of other income stays the same. They might have a pension benefit that continues on for the spouse even though one passed away. They might have required minimum distributions coming from their investment accounts that are staying exactly the same. And so they might have been, at $100,000 of taxable income right at the top of the 12% tax bracket. One spouse passes away, maybe the income drops to $80,000. But your tax bracket, top of the 12%, just went down to 50. So now all of a sudden you're in the 22% tax bracket when you used to be in the 12%. So that's what we call the widow's tax trap. Your tax brackets get compressed, your standard deduction gets cut in half, and your income doesn't get cut in half. So now all of a sudden you're in a much higher tax bracket, which can cause a lot of issues.
Oh yeah, that's a big jump. They will be almost paying double or at least 10% more in taxes. And so how can they avoid this from happening? Yeah,
I'd say one of the big things that often pushes somebody into that next tax bracket are those required minimum distributions that people have to take. So these are from pre-tax retirement accounts that haven't been taxed before. You're required to start taking withdrawals from those at a certain age. And so that, like right now, that age is 73 years old. So if somebody has, $1 million in an IRA, the government's forcing them to take out, let's say, $50,000 a year. Well, if a spouse passes away and that spouse leaves their IRA to their surviving spouse, it's still the same amount of money that's invested there, and that RMD is typically the same amount. In fact, it goes up every single year. Generally speaking, the percentage they have to take out goes up. So that income stays exactly the same and is now kicking you up into a higher tax bracket because those tax brackets have been compressed. And so what we'll do ahead of time, we'll do Roth conversions ahead of time. So that's one of the strategies that we'll use for clients. That's where we strategically pay the taxes in a known smaller tax bracket ahead of time, so that later we don't have those same required minimum distributions because the taxes have already been paid, and therefore it won't kick you up into a higher tax bracket.
So are you saying taking your current income, I'm confused, taking your current income and putting it into a Roth so that you can pay the taxes in advance?
You're taking money from your IRA and then you're moving it over to your Roth IRA, paying taxes in advance when that's done. And then therefore, once that money's in the Roth IRA, it'll never be taxed again, and it won't be subject to any required minimum distributions. So ideally, we're doing this strategy while both spouses are still living. But even if one spouse passes away, they still have that 1 year where they're still able to file as a joint filer. And maybe they have quite a bit of room to the top of the 12% tax bracket when they're a joint filer. And so that's when we'll do a Roth conversion that year. Oftentimes, if a spouse passes away, that's going to be a pretty big year for us doing Roth conversions, just
Right.
because we know what's coming around the corner. It's those compressed tax brackets, it's a smaller standard deduction, and oftentimes it's a tax issue for people.
So what if one of the spouses is still working? So let's say the wife is still working, she gets her normal salary, and then her husband passes away. Her normal salary would be in the higher tax bracket anyway. Is there any way to avoid that? Now that she cannot file joint, she has to file single.
Right. So I mean, that certainly that 1 year she gets to file as a joint filer still. If there's minor children involved too in that
Okay.
scenario, you actually get an extension on being able to file
Okay.
as a joint filer for a couple additional years. But certainly there's still strategies that we will use in that scenario, and it depends on how far away somebody is from retirement,
Right.
what their investment accounts look like, how much is pre-tax versus how much is Roth. But yeah, in that exact scenario, that income that she's getting, if she's still working there, she's still getting that same income, but her tax brackets have all of a sudden been compressed. So it's usually other areas of income that we're attempting to minimize, especially if your salary is staying exactly the same.
Gotcha. So interesting.
Yeah.
The web that's woven with
Yeah.
the widow's tax.
Right, I know. The IRS has just a ridiculous amount of rules that have to be followed, and so we want to make sure that we're thinking ahead on a lot of these things to help avoid getting into a tax situation later on.
That reference, I was thinking about the Black Widows.
Oh, right, yeah, there you go. That's right.
See what I did? Okay. No, okay, totally makes sense. And again, why we need a financial advisor. So thank you, Caleb.
Yeah, thank you.
Appreciate it. And if you would like more information about Foster Financial, we'll have it listed below. Give them a call, and I'll see you after the break. This segment sponsored by Foster Financial.